In today's video, we're going to talk about one of the fundamental property investing strategies, that's buy-to-lets. This is the ultimate guide to buy-to-let property investing. Hi guys, I'm Jim. Welcome back to the channel. Here we're going to talk about everything from property, investing and self-development. We're going to share everything we've learned already with you and everything we continue to learn in the future. So first things first, it's a good idea for us to define what a buy-to-let property is. Well, it's really simple. It involves purchasing a property and renting it out for rental income every single month. Now, normally people hold buy-to-lets for the long term. Investing in buy-to-let property certainly isn't a get-rich-quick scheme, but it is a get-wealthy over the long-term scheme. So, there's three major reasons why people invest in buy-to-lets. There's capital appreciation, there's monthly cash flow, and there's the leverage you get from it. Although the theory behind buy-to-lets is really simple and easy, all you do is purchase a house and then you're renting it out. It can be difficult at times, and if you're willing to commit to the hard work, it will ultimately build your wealth over the long term. So, what is capital appreciation? Well, ultimately, it's just the value of your property going up over the long term. Now, normally, property prices in the UK and the US double every single 10 years. Although it's not bang on every 10 years, the trend is generally moving upwards. So if you're willing to wait long enough, you will see the capital appreciation, which is the value of your asset, go up over the long term. Now, this is the part of buy-to-let investing which is making you money without you having to do anything. Like we stated earlier, property prices roughly double every single 10 years. So if you can ride it out and wait, the theory is that your property price will go up. Now obviously this depends on the market. You don't want to be selling at a dip because you could potentially lose money. But if you stay in the game long enough, you'll almost certainly make money out of property through capital appreciation. So the second major reason why buy-to-let is a really good investment is you get monthly cash flow. This comes from the rental income you get from a tenant. Once your tenant's paid you rent every single month, you have certain overheads to pay. This might be your mortgage, your letting agency fees, some insurance, and a surplus in case you've got to pay for maintenance or voids. Now, once you've taken these overheads away from your rental income, you'll get your net monthly cash flow, which is how much income you make from the property every single month. So like we stated, we're making money through our capital appreciation and we're making money every single month from our rental income. So the third reason why buy-to-let investing is a really good investment strategy is the fact you can get leverage on a property. So what do we mean when we talk about leverage? Well, property prices are generally pretty expensive. And if you're going to be a buy-to-let, you might be spending 80, 100, 120,000 pounds. Now it's going to be difficult for you to save all this money up in one go. Luckily enough, you can get leverage from the bank. Now all this means is the bank will loan you money in the form of a mortgage against the value of the asset, because ultimately they know if you stop paying the mortgage, they can seize the asset and sell the asset on themselves. This offers the bank a certain amount of security. So normally you have to put 25% deposit down when you're purchasing a buy-to-let property. This is when you'll hear the term loan to value, and this is just how much you're getting a loan or a mortgage against the value of your property. So if you put 25% deposit down, which is normal for a buy-to-let mortgage, you'll have a loan to value of 75%. So 75% the value of the property will be mortgaged. Now when it comes to mortgage for buy-to-let properties, there's two main types. There's a repayment mortgage and an interest-only mortgage. Now we're going to do a separate video explaining both of these, but I'll quickly dive into what both of these are. A repayment mortgage is really what it says on the tin. Every single month you're chipping down away from the actual principal of the mortgage. So you'll pay down some of the interest you owe and some of the actual value of the mortgage. Whereas in interest only, you only ever pay the interest of the mortgage down. The theory behind this is you want inflation, because inflation's going up over the long term, to chip away at the value of your house. So in 30 years time, £75,000 for example, won't be the same as it is today. But like I said, we're going to do a completely separate video on buy-to-let mortgages, repayment versus interest only. So now let's jump into some numbers on the spreadsheet. So the purchase price here is £90,000. Now you'll often hear the term BMV, which stands for below market value when it comes to purchasing properties. This simply means you're buying the property below the market value for it. Because whenever you purchase property, you make money when you buy it. So your purchase price for this property is going to be £90,000. So with a 25% deposit, that's going to be £22,500. But like we spoke about earlier, you can get the leverage via a mortgage at 75%. So the mortgage will be £67,500. Now, we've got a couple of different interest rates here, because the theory behind this is we're going to use an interest-only mortgage, but we're going to stress test it at a couple of different interest rates. So you've got 3%, 4%, 5% and 6%. Now this will be the cost of your mortgage per month. So all we're doing there is we're taking this, we're timesing it by that, and we're dividing it by 12 to get your monthly cost. So as you can see, 3% is £168.75, 225 for 4%, £281.25 for 5%, and at 6% we've got £337.50. And then if you look down here, you've got your rental income of £650. Now your rental income per year is £7,800. And this is where it comes to a thing called rental coverage. Rental coverage is something mortgage companies will always look at when analysing your property deals when they are going to give you a mortgage. But like I said, we'll talk about this in more detail when it comes to the repayment versus interest only mortgage video. But the rental coverage basically is how much does the rent cover the mortgage in terms of a percentage. Now normally they want 150%, so they want the 100% obviously matches it, and they want at least 50%, so at least another half to cover it as well. As you can see here, at the 3% the rental coverage is 385%, at 4% it's 288, at 5% it's 231, and at 6% it's 192%. So we're covered in all bases here, and this is why it's really important to make sure you stress test your property deals at different interest rates to make sure it still works even when the interest rate might be high, because the interest rates aren't going to stay as low as they are at the moment. So if we come back down here, we're going to work out our net monthly cash flow. So we've got a mortgage, and in this, if we use the 5% interest rate, so your mortgage there is £281.25, and then you've got your letting agency fee at normally 10% of the rental income, so 65 quid. You've got some insurance for 25 quid, which is always worth having. And then you've got voids and maintenance at 15% monthly. Now this is always worth having in a separate bank account in case anything goes wrong. So that's 15%, so that's £97.50. Like I said, this is your rainy day fund in case anything bad happens to your property. So that means your net monthly cash flow is £181.25. Now, like I said earlier, this isn't mega money, and it's certainly not a get rich quick scheme, but it is a get wealthy over the long term scheme. And like I said, you're going to be earning nearly £200 monthly cash flow income, which you will get every single month. But along with this, you'll get your capital appreciation. Now, at different points during your buy-to-let journey, you might be able to pull equity out, but we're going to talk about that in a later video. Now, we've tried some of the sexy models like Airbnb, and although the monthly cash flow is better from an Airbnb unit, it is a lot more hands-on, and it is more of a business than a passive investment like a buy-to-let investment is. Ultimately, we think buy-to-let property investing should be the foundation of every property investor's portfolio, and it offers you safe returns over the long term, and that's all any property investor should be in it for, is the long term. We hope you guys have enjoyed our ultimate buy-to-let property investing guide. It would really do us a massive favour if you could subscribe to the channel, smash the like button and turn on the notification bell. And also, let us know in the comments if you guys are currently invested in any buy-to-lets, or if you're thinking about investing in buy-to-let and you've got any questions, and we'll help you out in the comments. We'll also link our Instagram page, Jack and Jim Property, and our personal pages so you can check us out there. If not, we'll see you in the next video, guys. Cheers.